Hello, I'm Kristen Hull, and I'm the founder and CIO at NIA Impact Capital. And I'm thrilled to welcome you to our Wisdom Wednesday webinar. And we are delighted to be joined today by Marc Lichtenfeld, joined by my portfolio team, both Jethro and Samporna, and then also with Mark. And so the format a little bit different this time because we have a special guest. So I will have the privilege of being able to interview old-time friend and colleague, Marc Lichtenfeld, and he has written several books on dividend investing. A book that I've read a couple of times. I haven't actually read the most recent edition, so I look forward to that. And we're going to get into a little bit of conversation with Mark's background about dividends. Then we're also going to talk about how we use that in constructing our dividend portfolio. Many of you are familiar with our flagship portfolio, NIA Global Solutions. We also run several others. And so today, particularly during these volatile times, both geopolitically, politically in the US, and then also in our markets, it's a great time for us to talk about some of our other portfolios that behave a little differently during these times. And one of them is our growth and dividend portfolio. And so a lot of people had been asking, well, what about that? And we know about your flagship, but tell us more about this other one. So I'm excited to dive in. Marc, I'm going to read your bio, and then we're going to jump in. It's quite impressive, of course, and then we'll just jump into a conversation. We're so delighted to have you with us.
It's
Um,
great to be here. Thanks for having me.
oh, absolutely. I believe you're joining from Florida today, where it's probably
Yes.
much nicer weather than it is here in rainy California.
Yeah, it's kind of perfect today, like 72 and sunny.
Lovely. Okay. This is Marc Lichtenfeld, a dear friend and colleague. He's the author of Get Rich with Dividends, a proven system for earning double-digit returns. The book achieved bestseller status shortly after its release in 2012, and now it's available in its third edition. Um, this book, Get Rich with Dividends, was named Book of the Year by the Institute of Financial Literacy, and it's been translated into many languages, I believe Japanese, Thai, and Polish among them. Marc's commentary has appeared in Wall Street Journal, Barron's, U.S. News and World Reports, among others. And he is a sought-after media guest who's appeared on CNBC, Fox Business, and Yahoo Finance. And he is the chief income strategist of the Oxford Club. Prior to joining the Oxford Club, he was a senior analyst at Avalon Research Group. And Marc has many other talents. I'll just say that today we're talking about his investment talents, and yet he's a very well-rounded person with many, many other talents and pursuits. So Marc, thanks for being with us today.
Yeah, it's great to see you as always.
Yeah, I wish we were doing this in person. And I also really appreciate the power of Zoom for bringing us together during these
Mhm.
times. So sometimes technology really is our friend. So I'm just going to go to the basics and ask, how did you first get interested? When was your first thoughts on investing with dividends, and how did you come across that?
So I guess it would go back to when I was starting my career. It was, the mid to late 90s. So the dot-coms were just kind of ascending. The balloon was inflating. And, that period of time was very, very influential in kind of my thinking because just as my career was starting, we had this enormous bubble. And then, of course, the bubble popped. And so everything that I thought I knew about investing, and again, it was early in my career, but I thought I understood a little bit about valuation and what made a good business. And suddenly that was just thrown out the window, to trade these companies that had no business models, no revenue, no cash flow. And these stocks just went through the roof. But then, of course, they collapsed. And the NASDAQ fell, I think it was 66% during the dot-com collapse. And so that had a very profound impact on me. And so I wanted to, really shift my personal investing and any kind of influence I had on other investors into things that were going to be a little safer, a little more. I'm hesitant to use the word conventional because there's plenty of unconventional dividend companies and dividend growth companies, but certainly companies that were not just going to get chopped in half in the next bear market because of valuation resets. So you combine that with the fact that, it's hard to find anything better than passive income when, you get that income coming into your bank account or brokerage account and you haven't really done anything to receive it. It's just a great feeling. So it's really that, those two things, wanting to have something that's a little bit more conservative where you're not going to get destroyed in the next bear market or correction, and combining that with passive income.
Thanks, Mark. I'm going to realize that let's back up even a little bit to defining what we're talking about here. And so, which you're so good about in your book. But so um, I feel like I could have done a better introduction. So I'm going to take back some time and just say that at NIA, we invest in public equities, public markets, so publicly traded stocks, and we build concentrated portfolios of those. And within those, we love dividend paying companies. And so dividend paying companies are those companies where we are looking at their valuation and we are hoping that and expecting that, and with our analysis, believing that the market will help increase the prices so that clients make money because the price was maybe $70 a share when we bought it, and now it's at $90 a share. That's fabulous. This other added component of some companies is that they pay out a dividend. So, Mark, can you just explain a little bit more about the background of why a company would pay a dividend and which types of companies you're seeing would pay a dividend?
Sure. So, a typical dividend paying company is going to be a company that is generating plenty of cash flow and enough cash flow where they're still investing in their business to grow it, but they have leftover cash at the end of that. So they can do several things with it. They can go shopping for another business to acquire. They can buy back shares. They can hold it for a rainy day, or they can return some of that cash to shareholders in the form of a dividend. And so they'll pay. Usually, it's a quarterly dividend, and it's a regularly scheduled dividend. Although some companies will pay what's called a special dividend when it's just a one-off. But your typical dividend-paying company is paying, a specific amount every quarter, and then hopefully they're raising it over time. That's what I look for. But as a dividend investor, if you own a stock, you could, let's say, earn a 3%, 4% dividend yield every year, and that's on top of any price appreciation. So you're actually getting that income into your account. So if you own $1,000 worth of stock and you're earning a 4% dividend yield, that would be $40 cash coming right into your account, over four quarters. And you can either take that cash or you can actually reinvest it and just buy more shares automatically. That's called reinvesting the dividend. And that's also something I recommend strongly if you don't need the income right now, because it helps compound your wealth.
Thank you, Mark. So appreciate that. So what we're talking about are companies who have cash flow and then they have extra. And this is something that we look for at NIA as well. What are they doing with the cash? How are they spending that? And are they investing in themselves? Meaning that maybe they're investing in additional research and development. Particularly, all of our companies are known for pretty innovative products and services, and innovation often requires additional research, or as Mark mentioned, maybe shopping for a merger company to acquire that could enhance what they're already doing or open up a different business line. One of the things we like to see at NIA, least of all, and so I'll just mention it because it's an alternative to dividend investing, is the shareholder buyback. And there's a lot of reasons. That's probably a whole nother webinar about why we don't want to see shareholder buybacks. And what we do want to see is the company giving out a dividend, either investing in their own infrastructure, their own selves, doing additional hiring, more employees, more research, and or giving out a dividend to investors. And so that's what we love to see. And so that's one of the things that Mark and I have connected about over the course of our careers, is our strong love for dividend paying companies. So you kind of answered this, and I'm going to rephrase it a different way and see if there's more information from you here. Is just, why are you so bullish on investing in dividend stocks?
Well, there's several reasons. One, as I mentioned, they're a little bit more conservative typically. So in a market correction or bear market, they're typically going to outperform. You're especially a nasty correction, you're probably not going to lose as much as if you're in all growth stocks. So that's number one. And the dividend yield also, adds to that return. So if the S&P is down 10%, perhaps dividend stocks are only down 5%. And because you're earning, let's say, a 4 or 5% return, you're doing pretty well while everybody else is losing money. So that's a real big reason to have some protection to the downside. The other reason is, when you're buying stocks, we know the adage, buy low, sell high. Well, just by nature, by these stocks having 4% yields, let's say, right now, especially in this market, that's probably a value stock. Any stock, even a dividend payer that has shot higher, probably has a lower dividend yield. So if you're obtaining a halfway decent dividend yield, which I'll classify as 3% and up, chances are this is a value stock. And especially right now where valuations are so stretched, I like the idea of buying stocks that have a low PE ratio or low price to cash flow ratio. Some of these cheaper stocks, so that again, if there's a correction, the chances are that these go down less, and they also have a greater opportunity for their valuations to expand, and so to get that price increase. If you're looking at a stock, you're comparing a stock, let's say, with a PE ratio of 15 versus one with a PE ratio of 60. Sure, they can both grow, but chances are that over the long term, the one with the PE, a ratio of 15, has better upside opportunity.
Absolutely. Absolutely. We're very much aligned in our delight, I'd say, and fascination with well-valued companies. And, certainly those that are making the choice to pay out a dividend, makes so much sense. And then, as you mentioned, in these current markets, where there's going to be uncertainty, I don't think there's anyone on this call that would disagree that we're in a time where there's going to be some volatility and there's going to be some uncertainty. And as Mark mentioned, these are times when there can be a correction, there can be a market correction. And so being in dividend companies can be really exciting. On that, as we're getting into definitions and maybe some of the stereotypes that people think about, I would say people definitely see growth stocks as more sexy and dividend stocks as less so. And yet, I think you and I are here to model and exemplify that you can build beautiful portfolios with dividend companies. And so, what are some of the misconceptions or common misconceptions about dividend investing that you've come across or that you're hearing now?
Yeah, kind of like you were mentioning, that dividend stocks are just boring. They're not as sexy as growth stocks. And so, sure, when you have, some of these companies that are just exploding higher, some of the AI companies or quantum computing companies, whatever's kind of the trend of the moment, and these stocks are exploding. Sure, that's sexy. But those companies come right back down as soon as people's attention shifts somewhere else. But I think there's a misperception that dividend stocks have to be boring. There are some great companies out there that, first of all, may have quote unquote boring businesses, but their stocks have exploded higher. I mean, if you look at a company like Eaton, which makes electrical components, their stock is up about 6x over the last decade. So about like 600% over the last decade. That's pretty darn sexy to me. But then you can also look at a company like Gilead Sciences, which, as you may know, Kristen, they were the company that made HIV from a death sentence to a manageable condition. They cured hepatitis C. I mean, that's pretty exciting stuff. And this is a dividend growth company. It currently pays about a 3% yield. The stock has done well. So there are plenty of companies out there that pay a dividend, that generate loads of cash flow, and they're not your grandfather's utility company that's just barely chugging along, earning you 3 or 4% a year. There's some great companies out there.
Yeah. Thank you for that. And that's something that you and I share so much. And particularly Gilead. I grew up, I think, as you know, in California in the 70s and 80s. And in the gay community, it's very near and dear to my heart, a company that I followed for a long time. And certainly appreciate that they have a strong dividend as well as strong innovation, and they do continue to invest in their innovation. They actually do some interesting things in women's health as well. So very exciting there. And that's also part of the fun part for me and my team as portfolio managers to be able to come across what are some of the companies that both are poised for growth and yet are committed and have the cash flows available to be paying the dividend. So that's one of the special parts, I would say, about the NIA investing and some of the things I've learned, concepts I've learned from Marc. I'm going to jump to our last question, or no, I don't know. We'll see how many questions we have time for. But your book was published over a decade ago, and just curious, what do you hear from readers? What are you, what have been the responses? I know I was an early reader, so I'm one of those. What have some of your other readers shared with you?
So it's always great, when you hear from people who said, I've been following this for years and my portfolio has grown from, X to Y, and they provide those numbers and they're big. And that I always love to hear that. Believe me, that's why you and I are in this business, to help grow people's wealth. But the 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 emails that I get that really excite me are the ones where they say, I've since shown my kids or my grandkids even how to invest in these companies. Because if you invest in dividend companies, and especially dividend growth companies, over the decades, I mean, the numbers just become absolutely ridiculous. If you can hold a portfolio of these companies for 10, 20, 30 years, the numbers just really become mind-boggling. Just to give you an example, from 1980 to 2019, the S&P 500, if you invested $10,000 over that 40-year period into the S&P 500, just price appreciation, you'd end up with 179,000. And if you reinvested the dividend, you'd have $526,000. And so the longer you invest in these types of stocks, the more compounding works and the greater your wealth is. So if you can teach a kid, even an adult child or a grandchild, to do this for 20, 30, 40 years, I mean, their life is going to be radically different over that time. And it's the greatest gift you can give. So I love when I hear that people say that they're working with their kids and their grandkids. And then the other thing that I love is when they just say, yeah, this strategy helps me sleep at night. I don't worry so much. I don't check my portfolio every day or every week. It's just, more or less set it and forget it. I never recommend truly forgetting it. You should know what you have and what's happening. But for the most part, with this kind of a strategy, as long as your companies are generating cash flow, enough cash flow to pay the dividend, hopefully growing that cash flow, you can, for the most part, leave it alone. And that also is generally what's going to create a lot of wealth, is not over trading your portfolio and leaving a portfolio of great companies alone for years and years.
Thank you, Marc, so much. So we have taken some of these concepts and built them into what we do. Of course, we are active managers at NIA. And so while we're not active traders, we are actively monitoring all of our companies and particularly looking at cash flows and opportunities for dividends. And so, Marc, thank you so much. Before I let you go, there's one question for you in the chat. And it is, how often do we see bear markets?
How often do we see bear markets? I can't recall the frequency. I mean, they happen certainly every decade for the most part. But the nice thing about bear markets, as scary as they are, and look, nobody enjoys a bear market, they tend to be relatively short. I believe the average length of time is, it's either 17 months or 19 months. It's a year and a half. It's not that long to endure it, even though it feels awful as it's happening. But as dividend investors, it's actually a chapter in the book saying, or titled, "A Bear Market is Your Best Friend," as a dividend investor, because you can pick up these dividend stocks at much higher yields during a bear market. And if you're reinvesting the dividend, again, that's when you're automatically investing that dividend. You're continuing to buy lower and lower. And again, you're planning on holding these stocks for a long time. And as long as there's nothing wrong with the company, if it's just a bear market, the market's down, the economy's slow, what have you. But if the companies are generating that cash flow and paying that dividend and hopefully growing that dividend, then suddenly, you may have started with a 4% yield, but now you're reinvesting the dividends at a 5% yield or a 6% yield. So you're getting to accumulate even more shares, which generate more dividends, which accumulates more shares and generates more dividends. So a bear market really accelerates the compounding machine for a dividend investor. And so as long as you have the time and you don't need to cash out of your stocks at the exact moment a bear market's happening, a bear market is actually a really good thing for a dividend investor who can be patient and put money to work.
I feel like that question was queued up perfectly for you. So thank you for the person that asked that. Mark, thank you so much for joining us. We will put the link to your book in our follow-up, and just couldn't be more just really joyful that you were able to join us today. And I look forward to more in-person conversations soon. And in the meantime, go out and enjoy that Florida weather.
Okay, appreciate it. Thanks,
All right.
everyone.
I love that I got to share one of my influencers. Of course, Mark is straight up dividend investor, whereas we have other components to our investment process and our our portfolio construction process. And so now's our opportunity to just share how we think about both the dividend aspect combined with the other components that help us return both positive impact, sustainability, and return on investment to our investors. And so this is our growth and dividend portfolio. And I believe we're going to start some slides. Is that right? Okay. So we just heard from Mark. We're also going to hear from Jethro and Samporna in a few minutes. I think many of you on this call are well grounded in our solution themes, and those run across everything that we do, and they run across and throughout every one of our portfolios. And so here they are again. And just a quick backdrop is, these were invented in 2012, and really using systems thinking and asking the question, what is needed for people and planet, and combining that with what will the markets reward for. And so from my graduate work at Cal, I was trained in systems thinking and was able to use that theory in coming up with 6 different solution themes. And you'll see a slide later that they really do combine well and overlap with the UN Sustainable Development Goals. So what is needed for people and planet, and then adding the component for an investment thesis, what will the market reward for as we transition to the next just and sustainable economy. And so in our dividend portfolio, all of the companies have revenues coming from products or services contributing to one or more of our 6 solution themes. Let's go to the next slide. And what you won't see in any of the NIA portfolios is oil or gas. And we have been fossil fuel free since inception. And we're very proud of that, both because it's the right thing to do for our planet. And as you'll see from this chart, it's really the right thing to do for your portfolios. And so if you look at, these are the big sectors. So if the way Bloomberg divides up our economy into fossil fuels, you'll see here consumer discretionary, healthcare, technology, industrials, financials, largely our fintechs and our banking, et cetera. And you can see the blue line at the top is tech. And as Mark mentioned, there's so much volatility and yet lots of opportunities there. If you look at the red line, that is the oil and gas industry. And so had you invested in any of the other industries, now, of course, we're building concentrated and diversified portfolio. So we have various, at any given time, we have 8, 9, or 10 big sectors in our portfolios at NIA, and yet you won't see oil and gas. And so we're proud of that. There are some oil and gas companies that do provide dividends. However, that is not enough of a criteria to get them into our portfolios, because we really are investing in companies offering solutions that are helping in the transition to a just and sustainable economy. And so we can go to the next slide. The reason we include that is because I think a lot of the rhetoric around impact investing, do good investing, ESG investing, investing for the environment has been framed in a way that says, well, I wouldn't mind investing for the planet, but I don't want to lose money. And yet, if you are investing in oil and gas, you're in the last 10 years, you would have lost money. So we're trying to reframe and own that this is actually a really strong investment thesis. It's not just a do-gooder, nice thing to have. And so with that, why does it matter that we have gender diversity in our portfolios? And so I'm going to hand this over to my colleague and equity analyst at Nia, Samporna, who is going to talk through some of her research on these portfolios and then talk through some of these numbers. Over to you, Samporna.
Thank you so much, Kristen. So as we can see here, for this particular portfolio, as well as for all of our other portfolios at NIA, we are screening for gender diversity at the leadership level. For each of our companies, more specifically, the minimum criteria is to have one woman on the board and one on the executive team for a company to be considered for this portfolio and for the others as well. As you can see in this chart, we compare that representation of women at the leadership level across these various categories to the MSCI ACWI index. And specifically for this portfolio, the percentage of women CEOs and the number of companies with 30% or more women on board is significantly higher than the MSCI ACWI. What's interesting is that a lot of the women CEOs in this portfolio belong to companies that are located within financial services or REITs. REITs are real estate investment trusts whose very business model implies that they share the income that they generate from their real estate investments with their shareholders in the form of dividends. And so typically, since REITs pay a dividend, that we have a higher exposure to REITs within this portfolio. We have REITs across our solution themes, including sustainable planet, healthcare, as well as thriving communities. And then for this portfolio as well, we also track carbon intensity across our holdings, which is our scope 1+2 emissions weighted by per $1 million of revenue. And as we can see, again, compared to one of the indices, which is the MSCI ACWI, we have a significantly lower carbon intensity for the portfolio overall. What we have also observed is that there is a slightly negative correlation between the percentage of women on board and carbon intensity for each company, which means that the more the percentage of women on board, lower the carbon intensity for the company within this portfolio, which is an interesting sort of relationship between our gender criteria and our environmental emissions data. With that, I'm going to hand over to Jethro.
Thank you, Samporna. So as you can see, the chart on the left, so we run a globally diversified dividend strategy that, as I said on the chart on the left, you can see that it invests we invest across the market cap spectrum, including mega cap, large cap, mid and small cap names. Not only there, but also we're globally diversified across global sectors and industries. And you can see the breakdown in the chart on the right. So in addition to what one might consider some of the more traditional dividend-paying sectors that Samporna has already talked about, such as REITs, financials, and utilities. We're also excited about the dividend and growth opportunities we're seeing in sectors and industries such as natural and organic foods, select pharmaceutical companies, communications, and interestingly, in the dividend-paying value pockets of technology, which are actually outperforming the market year to date. So from more of a bird's eye view and looking at the overall strategy, the total portfolio is currently offering a dividend yield of about 3.1%, which is almost 3 times the market dividend yield of about 1.2% for the S&P. So we're excited and sort of happy at that level of yield that we're offering to our clients. And on that note, I'll pass it back over to you, Kristen.
Thank you, Samporna, and thank you, Jethro. So some of you had asked, I see a question in the chat, and then I also just want to make sure that you knew where we were available. Our flagship strategy, we've had longer and it's available more places. And in fact, they couldn't all fit on the chart. And I want to say kudos to largely our investors, because an investor voice is so important. We see that one, we get the economy that we invest into. We also see that investors can make a change. And so NIA is available at these platforms largely because investors have requested our portfolio there. And that can happen. So where we're available for the dividend growth, we decided we can't just sit on this portfolio. We need to get the word out about that. And so at any rate, this is where it's available. And if it's not available at a place that you would like it to be, at a place where you are currently banking or would like to have your investments, we're happy to help you request it there. And that is generally all it takes. Sometimes there's a due diligence process as well. Next time, we can share our alignment with the UN Sustainable Development Goals, because I know that's something that Sampoorna has been working on. And it's kind of nice to see that the money that you're investing in is actually going to companies that are working on some of the issues that are both near and dear to our heart, but also much needed in this transition to a sustainable, inclusive economy and environment. So with that said, we're happy to take questions and happy to stay on with anyone. You can put questions in the chat. You can also just ask us because we're a small group today. And let me just look at this one that says, why do you consider buyback wrong? So doesn't it mean company is showing confidence? So I wouldn't say wrong, or I could say that. I actually could say that. If a company has a lot more cash, we want to see them investing in themselves. And for us, that means, just as I said earlier, working on human capital management. For all of our companies, we want to see that they are showing their employees on the asset side of the balance sheet and not on the expense side. And so what does that look like? Strong employee programs, strong recruitment, and then also commitment to education and developing of employees. That's one way that we would like to see a cash flow going. And to us, that shows confidence, and that shows that you're investing in yourself. Similarly, as we spoke about before, R&D, research and development on whatever product, service, technology, et cetera, could be on operations. We love paying out extra money to shareholders in a dividend. What I don't appreciate personally is, and there's definitely controversial, is when companies use their extra money to buy their own stock. It can be said to manipulate the markets because they're buying so that the share price goes up. It's an inflated share price. It's not an actual increase driven by the market. So there's a couple of things. I could go on and on about that, but definitely our preference is to see them pay out money in a dividend. And we've built this entire portfolio around the benefits, as Marc discussed, of having dividend paying companies in your portfolio. Are there other questions? Jethro or Sampoorna, are there more things that you want to add?
I believe we have another question in the chat, which says, from Leigh Peters, I have a Schwab account and a Morgan Stanley account. Would opening a NIA account save me management fees?
Yeah, so that really depends on what you have set up at each of your individual brokers. We do know that Schwab accounts you can be managed without an additional advisor, whereas Morgan Stanley does. So, but happy to take that question offline and see what fees you're currently paying and how we can be supportive there. As we move into these times, 2025 and beyond, of course, we love our flagship portfolio, and that does pay a dividend as well. The criteria for that portfolio is a little bit different because we are a little bit on the growthier side, although we do have plenty of companies there that pay a dividend. And then in the portfolio we're talking about today, one of the requirements is that every company pay a dividend within this portfolio as well. So I'm happy to share. I think the fact sheets are on our website for both, but happy to provide any additional information as well.
There is one more question, Kristen and Jethro, from Michelle Moreno. How is NIA pivoting with what is happening with the administration, especially with Musk and the association with Tesla?
Yeah, that's a great question. So I guess the good news is we're not actually pivoting at all. We're doing exactly what we are here to do, and we're just very well positioned for these times. Some of you may have seen we've been a shareholder activist at Tesla. Even though Tesla is not in any of our portfolios, we removed it from client portfolios several years ago, back when we saw some of the initial problems, particularly with the CEO. One thing I said on a call earlier today is that for all of our companies, we expect that the CEO reports to the board. And they've shown many times over that that's not happening at that company. And also that CEO isn't even really present in that company. At any rate, we did win a shareholder engagement after many years there, and it was written up a couple weeks ago in the New York Times. We're happy to share that. As far as the current administration, there's certainly reason for alarm. And what we're doing is we are active managers. We are watching our companies. We are watching the highs and the lows of what might be a tariff, what might not be a tariff, which industries, which sectors, which countries might have a tariff, and then also relationships. As the question points out, there's going to be different companies benefiting from the people that are in office. And of course, we don't want to see that. We don't think that that's what should happen in a democracy. So we're certainly going to raise our voice about that while we watch individual companies. And then others had asked, in our previous call about specifically ESG, environment, social, and governance, and then also DEI, diversity, equity, and inclusion. And we are talking to our companies about having strong human capital management. That's essential to run any company, to be able to have employees that buy into the mission, that are loyal, that are committed, and that are really strong. And of course, the research shows that a diverse set of employees and managers and management has the best return on investment. So that's what we're talking to our companies about. And having that shareholder voice, that employee voice, the investor voice really does make a difference in holding companies accountable. So we're in some interesting times for sure, and we'll certainly report back on how some of these conversations are going. Thank you for these great questions. And we thank you so much for coming, for zooming in. There's so many things that are happening to grab our attention these days, and it's really great to see some familiar faces and to have our community here and learning about more of our investment possibilities. And we'll look forward to sharing more information. And for those that are interested, we'll help you get connected with this portfolio. Thank you so much.